In this video, we're going to have a look at BasicFit, one of the more recent companies that have been introduced to the AEX of the Euronext of Amsterdam. BasicFit has an explosive growth for the past few years, so we're going to have a look at their financials for the past 6 years and see whether or not we think BasicFit might be an interesting investment for us to buy right now and hold for a decade. So looking at their revenue numbers, what we see here is very much a growth story. They started with a revenue of 202 here in 2015 and they raised that all the way to 515 here in 2019. Now, of course, the year after, we all know what happened, which is the COVID pandemic, which was very beneficial for some companies and absolutely terrible for others. And especially for BasicFit, which is in the business of gyms, is very unattractive because of course during the COVID pandemic people didn't want to go to the gym or couldn't go to the gym because of lockdowns and social distancing. So what happened during that time as well is that the memberships were frozen. So people who had memberships and were already paying for their memberships just had that membership frozen so they can use it again when the gym started to open up later down the line. So that's why we see a very low revenue here in 2020 as well as in 2021. But I estimate this revenue number to go up drastically in 2022 again, as we have seen from the half-year report where they reported about 340 million in revenue in the first half of the year. So the second half is yet to come, so I expect them to double this number here in 2022 to continue their growth. And of course this growth is very much fueled by the amount of memberships that they have, and we can see here the amount of memberships in millions for the past few years. They started with about 1 million memberships here in 2015 and they increased that all the way to 2.2 million a few years later. As they doubled the amount of locations they had, they also doubled the amount of memberships. Now, of course, the COVID pandemic made it so that the amount of memberships that they had running have been decreasing because people didn't need a membership if you're not allowed to go to the gym anyway. So we see that their numbers here have stagnated, but they're coming up again in 2022. And we can also see that the amount of clubs they have opened has been steadily increasing, even though their memberships have not. So I expect a very big growth spurt here in 2022, 2023, as they're able to capitalize on the additional clubs that they have opened. So this brings me to an average revenue growth of about 7.7%, but if we actually increase this number to the number that I expect for 2022, we see a revenue growth of about 20%. So this brings us to EBITDA, the earnings before interest, taxes, depreciation and amortization. And we can see here that the earnings numbers have been steadily growing for the initial 4 years up until COVID hit, and then they dropped down. But for 2022, as we can see here in their half-year reports, in the first half year of 2022, they reported an earnings of 145 billion. So I very much expect the number here. To double this amount here in 2022. So that again, given that assumption, it gives me a growth rate again of about 20%, which is a very nice growth curve for a gym business. So this brings me then to the amount of debt that this company has. Now, of course, because of the insane level of growth that BasicFit is striving for, the immense number of clubs that they are opening every single year, of course this requires quite some upfront capital and this requires quite some leases. So of course they have to borrow quite some money to make this happen, and this is also very much what we see. So they have a debt here which has been increasing by about 11% year over year, starting with 250 million in 2015, which has risen all the way to 550 in 2021. Now I think it's important to know that the debt here, I only tally the short-term and long-term debt, but of course BasicFit, when they're opening new facilities, they lease the property where they host that. So if you include the leases into that net debt level, they have a debt of about 1.6 billion instead of 500 million. So it goes up quite a bit, but I don't think that's fair to include in that debt level, so I haven't done that for this particular business. So this leads me then to the excess cash on hand. We can see here that most of the time they tend to spend their money quite quickly to really fund that growth spur that they have. Now for the past 3 years they had quite some cash on hand to cushion any additional blow that might come their way, which is very nice to see. This brings me to the market cap here. They IPO'd in 2016, I think in June of 2016, so not quite in January or December, but this is the initial stock price, which has risen by 23.5% every single year. This brings us then to enterprise value, which is the entire value of the business. So enterprise value is the market cap to which we then add the debt and we subtract the cash. It's the total sum. Let's say a company like Planet Fitness wants to take over BasicFit because they very much like the business and like to own it as well. They of course have to buy the shares from the open market, but they also have to incur the debt that BasicFit has. So this is what we mean with enterprise value. It's the entire value of the business. EV/EBITDA ratio, what we see here is that their ratios are relatively high for a European company, but this is because BasicFit is very much in the insane growth stage of its shelf life. We can see here that the amount of clubs they have been increased by threefold for the past 6 years, which is an insane number and insane growth. And I'm not sure how much longer this growth spurt is going to continue, but I do know they have plenty of places and plenty of market share to take here in Europe. So I think this growth might take a few more years before it really starts to mature. So I think for that reason, the overall EV/EBITDA ratio of 14 times seems quite accurate for a business like this. I would personally even say it might be a little bit higher than that, but this is what it's been doing historically. Net debt to EBITDA, of course, as we've seen, they do have quite some debt on hand, and their EBITDA, their earnings aren't that high yet, mostly because COVID really crippled their earnings growth. So we do see some relatively scary numbers here, like in 2020, like in 2021, which are beyond our margins of safety. But the moment that we feel this inside the context of the COVID pandemic and we see the growth that they had prior to this, I think it's okay to say that these numbers are probably not entirely accurate and representative of the business as a whole, and I expect these ratios to come down in 2022. So this then brings me to cash flow from operations. This is the pure cash money that they make simply from running their business. And we can see here that their cash flow has been increasing quite steadily for the past few years. Now, of course, COVID, it really threw a wrench into their numbers where their growth has been declining, even though the amount of clubs that they have opened have been really vastly increasing. So I think these numbers are in no way representative of where this business might be heading in the future, and I might disregard them when it comes to my future projections. So this brings me to capital expenditure, and I think this is very much where you see the additional growth of this company. They spend a lot more in capital expenditure than they obtain with cash flow. So this means they acquire a lot more equipment and they pay a lot more leases for all the additional facilities that they are opening. They are heavily investing into the future, into the growth of their company, and this is very much where the appeal lies as well. Their capital expenditure has been increasing by 15% for the past for the past 6 years. So because of this, what we see here is that their free cash flow has been very negative for the past 6 years because they are expanding so much, because they require so much money to keep on opening new gym locations in the Netherlands and Belgium mainly, but they also have quite some clubs, I think about 300 at this point in France, as well as a few clubs in Spain and a few clubs in Luxembourg. So they are very much expanding in Western as well as Southern Europe. So this then brings me to the amount of shares outstanding. So they IPO'd here in June of 2016 with a share price of 14 euros per share. So we can see here for the initial 4 years that the amount of shares outstanding have been quite stable. But then of course COVID happened and they were already quite leveraged here when it comes to their debt level. So what they did, instead of acquiring additional debt, they diluted the share count. So they sold shares to the open market, 3 million here in 2020, an additional 7 million here in 2021, to make sure that they can keep on running the business, to make sure that they can weather the storm that COVID brings for them. And I think this is very much within their right to do so. Their story is based on growth, and I think shareholders will be happy to finance some of that growth if it means that they get a better return in the future. So free cash flow per share here has been negative for the past 6 years. They've been losing about €1 every single year. Free cash flow per share Like I mentioned, the IPO was of 14 euros a share and it's increased all the way to 42 euros here in 2021. Free cash flow yield is a bit fishy because of course their free cash flow has been negative, so we can't really use this number this much. Instead, I'll be using a number from some of their competitors like Planet Fitness in the United States. Of course, it doesn't translate one-to-one, not even close, but it's the best estimate I can possibly give it, and you can disregard this number if you'd like later down the line. So this then brings me to EBITDA. So I already know that in 2022, the first half earnings were 145 million euros. So if I expect the second half to produce slightly worse results than the initial half, I get an EBITDA of about 232, which is an increase of 100% of 2021, which I think is a relatively fair number to give them because we already know half of the answer and I want to be conservative with my second half, but I think it's actually more accurate than it is conservative. And what I'm going to do then is I'm going to project this company into the future by giving it a 15% growth for the first year and reduce the amount of growth they had by 1% every single year after that. Because I'm not sure if they're able to keep on continuing the growth that they've been having in the past. Now, for the past 6 years, they've been growing quite tremendously, and I actually do expect them to keep on opening about 100 clubs every single year. So I do think there's quite some growth, but of course the growth has to stop somewhere in the future, and I'm not sure how much market share they can really get. So I'm going to decrease their earnings growth for every single year by 1%. I'm going to use a market multiple of 16 times. Now, on average, they've been about 13.8, but I think for a company that's growing this much and for a company that has quite sticky revenue, right? I mean, people would always want to work out and go to the gym. It's not like a luxury product like a Ferrari that only sees interest the moment that the economy is doing well. I think BasicFit, because they're running on memberships, has quite sticky revenue. So I think because they are growing so much and because I expect the future revenue to be quite sticky, I give them a multiple of 16 times here in the future. Because even 10 years down the line, I expect them to still be growing relatively fast at a 7% pace, which is quite high. And I think they can probably reduce the capital expenditure in the future as well to really capitalize on this earnings growth. So with a 16 times multiple, it gives me an enterprise value 10 years from now of 9.4 billion. Subtract the debt, we add the cash, gives me a market cap of about 9 billion. Divided by the amount of shares outstanding, and I'm assuming here that this number remains the same. It may very well go up as they continue to dilute their shares to fund their growth story. But for the sake of argument here, because I'm not sure what is going to happen, I'm going to leave it at this number. And this gives me a stock price 10 years from now of 140 euros and 32 cents. So for the free cash flow method, it's going to be a bit more tricky to project this company into the future because right now they are not free cash flow positive. They have a negative free cash flow because they are investing a lot in opening additional locations for their business. So I expect them to very much continue doing this into the future because this is what their multiple and what their current price is based upon, the idea of growth into the future. So I think for the next 2 years, I expect them to have a negative free cash flow still of about €1 per share. But afterwards, I expect them to start to mature a little bit. I expect them to be more free cash flow neutral, if not free cash flow positive, as they are able to reduce the amount of capital expenditure and increase the cash flow, and all the clubs that they currently have running are fully operational and producing as much cash flow as they're able to. I expect them to be cash flow neutral here in 2024, 2025. And of course, after this period of maturation, I expect them then to... So then for 2026, I expect them to have a relatively positive free cash flow per share, which I'm going to increase by 10% in line with the EBITDA growth. Now, in all fairness, I'm not sure whether or not this is true or not, because I actually think they might actually take longer for their growth story, take longer of negative free cash flow as they continue to expand their operations, because I'm not sure how long this will take. This is just my estimate and the blind dart that I'm throwing on the board here. I'm going to give them a free cash flow per share of about 2%, which is the number that some of the competitors like Planet Fitness have been going for. Now, I'm not sure whether or not this is accurate because, of course, this is a European company and not an American one. So I think these ratios will really shift. But again, the free cash flow method, I'm not sure exactly what is going to happen. So I think this is very much a shot in the dark for me. So looking at the share price right now, I can buy as many shares of BasicFit as I want for €32.54. If I take both my estimations and cut them down the middle, I get an average share price 10 years from now of €108.26. This gives me a compounding annual growth rate, a direct return on the stock market of 12.8%. But the moment I include the free cash flow that I expect them to be generating about 7-8 years down the line and include this into my calculation, I get an internal rate of return of about 14.8%. Now, like I mentioned, I'm not sure actually how accurate the free cash flow model is here. So the moment that I'm just looking at the enterprise value model, what we see here is that we can expect a compounding annual growth rate of about 15% with an IRR of 18%, which still includes this cash flow, right? So at this moment, we can probably discard this number and just look at this one, because I think this one we can project, and this one is really just a gamble. It's anyone's guess. So let's then see what happens if the stock price either goes up or comes down. Now, right now, I can buy as many shares as I want for €32.54, which gives me an IRR of about between 15 and 18%. So the moment that the price starts to come down, even to like the €26 range, I expect an IRR of 21% or a compounding annual growth rate of around 18%. And I think this is very attractive as an investment, and I think this is a very steady projection because of how they've been doing historically, and we can kind of grow their EBITDA in line with the amount of clubs that they have open. So I think when it comes to projection, I think BasicFit is relatively easy to project compared to other companies like semiconductors or airline companies. So I think this is a very accurate picture. But of course, what you do have to realize is that you are investing into growth. You are not investing into cash flow. So do not expect a dividend or a share buyback for the upcoming 5 years, because they simply have to use all their capital for growth. That is the reason that you invest in a company like this, because you want that potential growth. And I think when it comes to that, I think BasicFit is a very steadily growing company with a very sticky revenue, which I personally think is quite an attractive investment, and I would definitely be looking closer at their financials and their statements to see whether or not I'd be interested in buying this stock. So that was BasicFit. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!